sellers. And that's why you have this battle. But look at this. The sellers, they tried. Okay, now let me erase all this. The sellers tried once, twice, 3 times, 4 times they tried to drive price down. And each time the market starts pushing up. Okay? So how do we then take this information and go try and make a couple of bucks? Well, first of all, this is not some kind of prediction. Okay? This is not some kind of prediction. What we have to do is observe the market pattern. That's what we're trying to do. What is the pattern? And then we have to think about why, based on supply and demand and what we know about how the market has to react, does that pattern mean? Now, of course, it doesn't mean that this is going to be 100% correct. It's never going to be 100% correct. But that's when we can use things like probabilities and money management and risk management in our favor. Because let's look at this thing logically, okay? Again, remember, in liquid markets, if the market is moving down and it cannot continue to move down, the market will probably move up. And it really is for just one simple reason. Because there are so many opinions about where the market needs to go. That's why. That's why in a liquid market, it's constantly moving. I mean, think about it. If you have major countries that have their currencies publicly traded, like the United Kingdom, like the United States, like the European Union, there are always going to be people who have opinions about where that currency is going to go, and those opinions drive price. Pure and simple. That's why we know if the market cannot continue to go down, it's probably going to go up. Now, all of these other techniques and tactics are used to estimate where that change is going to occur. Okay, where is it possibly going to stop going down and start going up? So, for example, we could take the move from here to here and run a Fibonacci retracement to try and figure out if the market does start moving down, where is it likely to reverse? Now, I say this in the course materials that I put out about the Fibonacci retracement. Nobody knows why this works. It's just a pattern that does work. It's a pattern that provides an observable event. It helps us to key in on a single price and then watch that price. So as the market is moving up and it puts in this high, and believe me, this high is put in after this month is over. Okay, this is December of 2006. So when on January 1st, when this market opens up right here, we know that based on this little run up on the market, that this 38% level represents what I would call an aggressive trend. Meaning, if the bar cannot close underneath this level, that means that the trend is probably aggressive. That's just a pattern that I've seen over and over in the marketplace. And there are a lot of reasons for that. I already explained some of them, because you're going to have some firms which come in here and say, hey, if the market gets between 94.25 and 92.15, we need to buy. Okay? That comes in right here. That's why, that's the theory at least of why this stuff works. So by taking first the common sense approach of looking at if the market is moving down and it can't keep moving down, it's probably going to move up because of all the opinions in the market, then we need to look at areas where that is likely to occur. That's all we need to know. Is it likely to occur? How do we know it's likely to occur? Based on past pattern.